Hi, welcome to Sponda. My name is Gustavo Sayani. I am the creator of Sponda. And this is one more video in our series about the fundamentals, about the basics of investing. Before we dive in, I heartily invite you to use Sponda. Just go to your favorite browser, type sponda.capital and your enter key, and you'll be there. It's free, it does a lot, and I'll be more than delighted to know that you're using this tool. Today we're switching gears a little bit. We spent a handful of videos talking about risk, talking about debt, and today we're going to talk more about the possibilities of good opportunities. Specifically, we're going to talk about price to earnings. So, in essence, price to earnings is what a company costs and what the company makes. And this actually packs a lot. Books can be written about this. I'll be brief. So let me use Meta, the maker of Facebook, Instagram, and show you where to find this in a company's page at Sponda. So if you scroll just a little bit here, we can see something saying PE 10 of 40.6. Okay, so as a matter of fact, this number 10 is really where Sponda shines, and really where Sponda is very different from the vast majority of what's out there. With all due respect to the other tools, very useful. But here's the thing. What is price to earnings? Let's say a company makes $1 million a year. And let's say a company costs $1 million a year as well. So that would be a PE of 1. And it would mean that after 1 year, so you purchase that company for 1 million. And after 1 year, the company will have earned 1 million. So it's very quick that you get your money back. So this would be like just the most amazing deal possible, right? Now, on kind of like another extreme, let's imagine the same company earns $1 million a year. But to buy it, you would have to spend 100 million. So to get your money back, you would need to wait 100 years, right? That's a lot. Like, we don't live that long normally. So this ratio needs to be of such a size that you can get your investment back soon enough, right? So that's PE. Different people, as always, use different rules of thumb. So if we take our Warren Buffett, I've heard him say or be quoted as wanting to buy companies at PEs of 10 or less. And there's like a good calculation which is the opposite of that. So imagine you buy a company at a PE of 5. So the math is very simple. So you divide 100 by 5. And with this, the result is obviously 20. It's almost as if you would expect an annual return of 20%, which is pretty much what Warren Buffett was able to do over 70 years, which is completely outstanding. Now, if you buy a company at a PE of 15, it implies you expect a return of 6.66%, assuming the future will be like the past, right? Cool. So there's a lot to that, and there's a lot you can Google and read further from many sources. But what I want to show you about Sponda is that this idea, like, what will the future look like? It can be better or worse projected. Definitely, like many investors, many people go and look at PE over just the last 12 months. And that's very error prone because things oscillate a lot. for many reasons. So I would be very loath to investing in a company just because of what's happened in the last year, right? I prefer to look at as long a term as I can. And that's where Sponda shines. So if we look at Meta, and it says PE 10 of 40, like I would absolutely never buy a company at a PE 10 of 40. Because I would either wait 40 years to get a break even, or I would have to assume this company will be far better in the future than it has been. Now, if we do it over the last 5 years, we may or may not see a more favorable picture. In Meta's case, not so much, 34.8%, right? And it looks a little better over 3 years, but not so much, right? I randomly picked an example. I did not try to be illustrative here, but you will see as you do your research companies where the last year wasn't so good, but other years, if you take like a longer term view, things get much better. Maybe like Vale is a Brazilian company. That may be a good example. So here, PE 10, 7.4, which looks at face value way more favorable than Meta. And if you go here, it keeps, so it kind of gets better and then it gets worse. So if you take just last year, the multiple was 28, so not good at all. But if you say like the last 5 years, it's 4.8. You see, like this is a mining company. People say it's a cyclical company. And yeah, indeed it is. So there you have it. So this is why it's super important, super useful. I would say you cannot not consider this. So that's PE in a nutshell. Thank you very much. We'll come back with more indicators in future videos.